I'm Amy, Head of Learning and Development and Support at Rachel. And we are so grateful to have you today, and as well as to have Martin. And what we'll be going through today is DSOs, daily sales outstanding. And we're going to be going through what is that, how do we calculate it, who's responsible for it, and so that we can understand how to use this in our day-to-day life. And we're so grateful to have you, Martin, with your years of experience. And this is something you're very passionate about as well, to say, you know, if you can decrease your daily sales outstanding, the effect it has on your business, which relates to our conversation that we had last week around capital and cash flow. So I'm going to allow you to take it away, and thank you so much for sharing your knowledge with us today.
Thank you so much, Amy. Thank you for the introduction, and thank you guys for joining us today. A DSO, I've heard a comment recently where someone said it's an irrelevant measure. And I thought to myself, I wonder why someone would make that comment. It is like your petrol gauge in your car. Imagine you didn't have that gauge, Amy, and you were driving around and never knowing how much petrol you have in your car. It's a pure guess. You just wonder when you're going to run out of it. You've got nothing to measure or to tell you how far you still can go before you run out of petrol. And that is what a DSO is. A DSO tells you how long it takes you to get your cash in, when will you have it, and how much it means to you. That's what DSO means. And so many people think of it as just something that you calculate at month end, and it tells you how good you are or how bad you are. Not really. We're going to discuss that today, and we're going to talk a little bit about it, and then we're going to talk how to calculate a DSO and what the important factors of it is. DSO has a direct connotation to what we call cash conversion ratio. What the hell are you talking about, Martin? The cash conversion ratio is something that we're going to talk about in the future when we talk about the difference between cash flow and cash flow forecast. But cash conversion ratio is how quickly are we turning something into liquid cash that we can have and can use to build our business and grow our business. And that is also where the DSO plays a major role. You know, yeah, you've heard me talk about one day DSO equals a certain amount of value. I'll talk about how you can calculate that. And if you reduce your DSO, that's got a direct influence on your cash. And that has got a direct influence on your purchase capability, a direct influence on your spending capability, on your building of your business capability. All of this is influenced by just this one thing. All right. So without further ado, let me just go find presentation. Share, Amy, so you will tell me once you...
Yes, I will. So just remember, if you unshare, Martin, and yeah, just open that. You're still sharing your screen, so you want to unshare and then just share directly from. So can you see where it says present? You're going to want to present in Teams.
They present at the top right.
Yeah, okay. There's a little drop down next to it that says, there you go. We can see it. Can you see? Works. Can you see your notes on your side?
No, I can't.
Okay, so what must just unshare your whole screen with us, so don't share with us. Okay. Now on your presentation, you'll see in the top right-hand corner, it says present in Teams. Open it up onto your desktop, like download it from the Teams message that we had. Technical difficulties, guys.
It says present, so I click on present.
No, it should say present in Teams, but you're clicking on it inside Teams. Just right click on it, say open in PowerPoint.
Doesn't give me that capability. Must I right click on the actual presentation?
So if you're in the conversation between us, you'll see there's like 3 little dots in the corner of the presentation. So you'll see, yeah.
Okay.
Then it says open in and say desktop.
You mean at the bottom end of the presentation?
Yes, the bottom end, and say open in desktop.
Hold on. This is a lesson for me in how to use.
This is a lesson for me too. Hey, I'm still a PowerPoint user. Yeah.
More. It says okay. Now it says open, download, open in. Okay.
So yeah, you can say open in PowerPoint, open on desktop, and now you should see where it said present before, it now says present in Teams.
Yeah, and then I just click on screen. Are you guys now able to see it?
Not yet. It just might take a moment.
Let's see your name icon change at least. So that's a good sign.
Still not coming.
If at worst case scenario, Martin, how you had it in the start isn't actually too bad, because even though we can preview the slides.
Let me see if I can do it for you.
Because it's not happening on my side.
It should pop up and say presenting in trade shield organization. So just let me show you where I'm clicking. So I'm just going to share my screen with you. Martin, can you see my screen?
Okay.
Can you see this button here?
Presenting Teams, yes, I can see that.
Okay, so that's what you're going to want to press.
Okay.
And when you press it, you're going to press it and then come back to our team chat, and here you're going to say present.
Come back to our team chat.
I see. Okay.
Let's see if I can do that. Let's try again.
Okay. Now, everyone on the call not only are going to learn about DSOs today, but also how you can present directly from your PowerPoint presentation into Teams. What's really nice about it, it means that the people watching the Teams meeting, which you'll see in a few minutes, we only see the presentation, but Martin will see the notes that we made as well, so that when, the talking points to say, make sure that we cover all of these things without putting everything onto your slide.
I have no idea what's happened to my Teams now. Now I can't even find my Teams.
Did you download your presentation?
I have, but now you see the thing is, now my Teams itself has closed at the back. So now the only thing I have open is this discussion. Open Teams for me, and you do the sharing, and I'll do the talking.
You can right-click on the Teams icon. If you right-click on it, then you can go and you'll see that you can click on it. It just says Microsoft Teams, and it's got the little icon. Then it will open Teams again, regular Teams. Did that work for you?
Got it. You see, mine does not show that present in Teams that you've just shown me, Amy.
Okay.
Doesn't show you. It just says present. It just shows present, and then that's it.
Oh, maybe I have an updated version. If you click on the little arrow next to the present, is there nothing there for you?
It doesn't create a drop down. Oh, there it goes. Start from the beginning. Present in Teams. Let's see that. Okay. Now that says resume in PowerPoint, or try again in Teams. Oh, yes, this thing is trying to open Microsoft. Okay. Are you guys going to see it now? Do you see it?
There we go. We see something.
Now we see something.
Right. I just clicked on present, and now nothing's happening. Oh, there we go. Jeez, like.
There we go.
Oh, Bullet has learned something today. You're never too old to learn.
I see some claps. Lovely.
Thank you. You see what I say? And that's Please.
At least I can say I have more skills than just credit.
Indeed.
You are never too old to learn. If you can find something new to learn every single day, every day, this is where you're going to be. So you are now seeing the full screen. Am I correct?
Yes, we are.
Okay. All right. So guys, without further ado, we've now lost about half an hour with Martin battling to wake up. Let's start today's class about the DSO. On the agenda, we're going to talk about why cash timing matters, understanding the business impact of delayed collections. Well, I mean, I don't have to preach that to you. You as credit control team should understand that and know that. The cash cycle in practice, where time lives between sales and payment. That's also terms, and that's something you decide. What DSO really measures, from terms to real behavior. Financial impact of delay. How small changes create major funding pressures. And you know, it's easy. Sometimes someone says, so let's do this or let's do that. Yesterday, I did an analysis for someone on an aging, and I quickly saw that they have two of their biggest clients with the most money outstanding with the longest terms. No wonder this company's got cash flow problems. Identify risk early using payment behavior as intelligence. So where can you see payment behavior? In the movement of a DSO of a specific debtor. What world-class credit teams do differently, moving from reactive to strategic, and then turning insight into action, what you can influence tomorrow. What you do today has always got an impact on tomorrow. And you know what? In the credit world, and very few people actually understand this, one of the most critical things in collecting debt is relationships. The better relationship you have with your debtor, the better you will understand their payment behavior, vice versa, your collection activity and strength. And it's all to do with that relationship that you have. If you have no relationship, trust me, you're going to battle with your collection. DSO measures how long it takes to turn a sale into cash. Now, we all now know what days sales outstanding means. It's one of the most important indicators when you talk about cash health or credit in business or how business is driven. How long does it take from the moment the sale is raised till that moment that the cash is in the bank? You know, people always say a sale is not a sale until the cash is in the bank. And this is what we're talking about. What is the influence of a high DSO? What is the influence of a low DSO? And there we say, high DSO, your cash comes in slowly, or funding is required. Why? You don't have money, so now you've got to go and borrow money to manufacture, or to purchase more stock, or to pay your staff. And now you are starting to put strain on your cash flow. Higher exposure to default. What am I saying? The longer stuff cash stays outstanding, the more difficult it becomes to collect that cash. Any outsourced collections will say to you, if something is in 30 days and we collect, we take 5%. If something is in 120 days and we collect, we take 45%. I'm just using figures now. Why is that? Because of the complexity and the difficulty in collecting the older cash. Pressure on borrowing and less flexible growth. So with other words, you are not so flexible to spend money to grow your business. Why? Because you don't have cash. And of course, the longer it carries on, the longer you battle with your cash to bring your cash in, the more pressure you put on your business, the more you borrow against assets, and at the very end of the day, you're not going to have any more collateral left because you've given it all to to the banks, and you're going to get your business into a state where you're going to say, I now need someone to rescue me. And that's when you go into business rescue. And all of this, because you've ignored one critical factor, that movement in the DSO. Okay, if you have 60-day terms, in a perfect world, your DSO should be 60 days. If you have 30-day terms, in a perfect world, your DSO should be 30 days. And it also depends on if you are working from date of statement, or date of invoice. Those are two different types of payment terms, and that also has an influence on how your cash will move in your business, but it still calculates a DSO. A lower DSO, cash is fast into your account. It comes in quickly. You've got cash available. You don't have to borrow. You don't have to pay interest on your cash. You earn interest on your cash. Less funding required, lower risk. So the faster your money is in, it's in your control and not in your debtor's control. And stronger liquidity. We heard Rahul talk about liquidity the other day. And liquidity means you have liquid, moving, available cash. And that is what businesses thrive on. How do you grow a business? By having liquidity. More capacity to invest. However you want to invest. If there is a certain portion of that profit that you make every month that you want to invest for a later stage, I'm talking about smaller businesses or even bigger businesses. If you invest in growth, open more branches, expand your factory, expand your warehouse, all of this is done when you have cash available. All right, at its core, it tells us how long it takes to convert revenue into money. Revenue is the sale, cash is the money. Not when we invoice. It's when the money is actually in the bank. That's the liquid part. Now, why does this mean that? There we go. All right. Interpreting DSO for financial health. A high DSO comes back slowly, cash. More funding required. Greater exposure to problems. When DSO increase, there's pressure on your business. Lower DSO, cash returns faster, stronger liquidity, more room to grow. You know, if we understand what a good DSO for our business would be, we will start working strategically around that and to make sure that we have the correct team with the correct capabilities, with the correct tools to ensure that everything we do and we are in control of is going to ensure that our payments are made according to our expectations. Higher DSO means customers are taking longer to pay. Now, that could be for different reasons. It could be, and trust me when I say this, 85% of the time, when a debtor doesn't pay you, it's your own fault. Our own fault. Let me put it the reverse. It's my fault. Why? Because I'm talking out of experience. What is wrong? You either are not following the client's requirements for an invoice to getting paid. You haven't got the correct documentation with the client. You've got the incorrect pricing. You haven't got a purchase order attached. The purchase order is depleted, and I can carry on and on about reasons for an invoice not to be paid. In South Africa, most creditors, people that owe you money, look for reasons not to pay the invoice rather than looking for reasons to pay the invoice. So we, as credit suppliers, should make every effort in our control to ensure that the documentation and the invoicing that we do is correct and it goes out to the client correct. I always talk about, and I'm preaching on something that you must be tired of this by now, is know your client. If you don't know the process of your client, what is going to happen once your invoice gets to your clients until the day they pay you? You are always going to have a battle to understand and get on top of your DSO. Control the movement of your money. Understand where the hiccups are. Understand what you need to do to accelerate this process. Every time an invoice leaves your business, it is you've now given this company either a service that you've rendered or a product. And now you're waiting for payment. You are almost like his bank now. You've given him something that is worth cash that he or they are now using to generate cash on their side. And now they're sitting with your cash. And now it is for them to pay you. However, if that invoice that you've now raised is not correct, that's where you're difficult. I'm always of the opinion that when companies start getting constrained in their cash, it is, I can almost say, reckless selling.
Do you want a cup of tea? Melody,
Yes.
I would love a cup of tea. With flavor.
So do all of
the regular Ceylon.
Sorry, now I don't know what happened. Can you guys still see my
It's
presentation?
been handled. Yeah, keep going. The screen we are now seeing is how business use DSO.
But I don't see it. I don't see any.
If you go back down to your, you should be in your Teams. Okay, now you're unshared with us. Okay, yeah, click on those three dots.
Yeah.
So open in.
Not doing anything.
It doesn't like you. There we go. Open in on desktop or in Teams. It's fine.
Okay, there we go. And now present in Teams. Resume. Can you see it again?
We're still seeing the full screen, not what we should be seeing. So there we go.
Is it back again?
Yeah, just maybe scroll back to just push this. Yeah, next.
That's it. All right. The important part is that the slower your what's the name, or the higher your DSO, the slower your cash comes in, then your focus starts changing. Because now you don't have cash. Now your team is starting to run around looking at all kinds of things, where to generate cash from and how to get cash in. And that is when your focus in your business starts shifting as well, because now it creates different pressures. However, if your admin process is in line with your client's process and your DSO is under control and your cash flow comes in, your team is focused on what they should be doing and not focusing on other things. A lot of people say, Martin, yes, but for us to grow business, we sometimes need to take risks. We sometimes need to do things that is not always easy. The question I always ask is it really worth putting your business under so much strain? The other day, I wrote a little article about small companies and why they put themselves under so much stress. And it is because they engage with these big blue chips. And these big blue chips have got slow processes, have got lengthy processes, and it stretches a DSO. The DSO, which is directly linked to your cash flow, is then putting your cash flow under strain. And as I said just now, we talk about then starting to borrow and starting borrowing against all your assets and then putting your assets under strain. And then they want to know why they can't make money out of these big blue chips. It's because they are not aligned with those processes. They don't have that capability. Slow, small bites make you grow into that state where you can accommodate those kind of clients. How business use DSO? Performance shows how effectively you collect. Customer risk highlights who may be struggling. The minute the DSO of a company starts going out, first question always is, how can I rectify it? Is it something that we are doing wrong? If it's not, then we need to understand what's going on in our debtors world. Now, if we're trying to understand what's going on in our debtors world, it's not always that visible. It's not always that clear, but there's a lot of things. For instance, trade share will tell you when the payment risk or the default risk is changing. Why will it tell you? It measures how someone behaves according to the payment terms that they've been given. Is that behavior changing just with you or with everyone? Is the default risk starting to change? With other words, is there a good possibility that they're going to default on you in the next 3, 6, 9 months? And when those changes happen, you should then ask yourself the question, what is it that I need to do to rectify this or to prevent a default or a bad debt happening? Should I start reducing my exposure? Should I start asking for collateral? And I always say, once you start asking for collateral meaning securities. Personal surety is not collateral, it's just a surety. And you don't always understand the value of it. Collateral meaning a notarial bond, a bond over property, a bank guarantee from your debtor, credit insurance, all those kind of things. But that costs money. How does a notarial bond cost me money, Martin? You got to understand exactly what value that notarial bond has. You constantly have to inspect what there is because it's movable assets that you are taking as a bond. So you have to know what there is to what you have connotated that value. And that takes time and that is cost. That's what I'm saying. When you start moving in that world, it's a different expense that you're starting to have and it eats into your margin. Remember, I always say every month you take is probably 1% of your margin going. Now imagine if you now start putting these other things onto your pressures already that you have in, you are eating into your margin again. It's costs that you have that is not always that visible, but in the end of the day you say, but we sell so much, but we don't have money. It's because you have given away your margin with all kinds of other activities that you've done to try and change someone's behavior to improve your DSO. Early warnings, movement signals future pressure. We've just spoken about it. When you start seeing those movements inside your debtors ledger, and it's always good to calculate the DSO on debtor level, and TradeShield does that for you. Not the DSO, it is a weighted average, but it's very similar. So it also gives you a good indication when there is changes taking place. All of a sudden, a client that you've never received queries from has queries. I'm not talking legitimate queries. When they start asking for copy documents, when they start saying that they didn't receive the documents, yet you are still sending the information to the exact same spot, to the exact same people like you've always done. And all of a sudden, you're now starting to experience difficulty. That is the one first sign. And we've spoken about it also when they start to pay you in round amounts. Why? Because that's all they have. That's the only capital they have available to pay you. So now they pay you in round amounts. It's a little bit different in some of the FMCG worlds because there the clients might buy on a 7-day term and they have cash and they pay it in, especially when you have informal settlement businesses where guys are trading in cash only and they work in a different way. But you quickly pick up that behavior and you understand that behavior and you manage the risk according to the behavior. How is a DSO calculated in practice? Okay. One example is 30 days from date of statement. The customer pays you and agrees. In a perfect world, it will be 30 days. If it's actually 45 days, it means that the client or the debtors are stretching you to 45 days. So if your sales are X amount, you divide it by 30, and then you know what 1 day DSO is worth, and then you times it by 15, and you now know how much of your cash is caught up in that 15 days that you are now waiting for your cash. So let's say if 1 day DSO equals R1 million, that means 15 million rands worth of cash is not in your pocket, not in your bank, not earning you interest, is lying somewhere else due to something very specific that you now need to focus on. Example 2, of course, we've got 7-day terms and 30-day terms, and the percentages of, as the example says, 40% of your clients are buying you 7 days and 60% of it is in 30 days, then this is how it will break up. And that's also where you're going to have a difference in behavior. If you have a lot of shorter term clients, your terms, your DSO is going to be shorter as well, because there's activity that is different to the normal activity. Now, some people's 7-day terms are 7 days from date of statement and not necessarily 7 days from date of invoice, also a different calculation. You've got to understand the terminology that you've used in your terms and conditions. And when you start saying in your terms and conditions that these are our terms, make sure that your system that you are using, your major platform, your debtors control platform, your ERP system, works according to what you say. If you say it's from date of invoice, then your invoices are going to roll on a daily basis. If it rolls once a month, then your system is geared from date of statement, not date of invoice. You are confusing yourself. You are creating problems for yourself because you're expecting money to come in at a certain stage, but it only shows overdue on your client's statement at a different point in time. You understand what I'm saying? And remember, these guys are geared to pay according to what they have on paper, not what you tell them. The agreement that they have. So make sure that the two correlate with one another. How do those calculated in practice? Example 1, monthly credit sales, and then your daily sales divided by 30. That tells you how much 1 day DSO is worth. The customer pays you 30 times 100,000, it's 3 million. If your actual DSO is 45 days, 45 times, it means it's 4.5 million of extra funding required, 1.5 million. Remember what I said just now, you don't have the cash. You still need to operate. You still need to do something. You still got to pay staff. You still got to pay creditors. You still got to lay out money. And if you don't have it, means you got to borrow it. And what do you borrow it against? And of course, there's the constraints and the strain and the stress and the pressures you are putting on your business. And this now needs extra control, extra people, extra time, different focus, instead of the people focusing on the easy and the correct things. Monthly credit sales is 3 million, 40% is 7 days, 60% is 30 days. Your expected DSO is supposed to be 21 days. And once again, the same calculation. And it shows you that the slower your DSO, you have that exposure of that capital lying somewhere else. And I mean, this is a small calculation. If your DSO, if your sales are far more than 3 million a month, then very quickly that value of that money lying outside grows to an enormous and astronomical amount. And that's where the problem starts, and the problem starts coming in. When should you worry about your DSO? Suddenly or unexplained increases requires attention. If you are not constantly in control and understanding your client, knowing your client, and knowing their behavior and measuring their behavior and watching what they do, they are going to change that behavior and you are not going to see it happen. And what's going to happen then? Your cash is going to sit somewhere and you're going to have a problem. Weakening collections, softer discipline, or higher risk customers. People start giving credit to high risk customers, and that is going to change your DSO, and that is going to change your cash flow, and that is going to put strain on your business. I know sometimes when a company is sales driven, and I laughed the other day with one of our credit managers of one of our clients when she showed me a client that Trade Shield didn't want to give credit to, and the insurance company didn't want to give credit to, yet the big boss said, give them credit. And now the poor credit managers deal with the problem because they now have to collect that money that we already have told them is not going to come in, is going to be difficult to collect. Now you have now got to focus on that, and your focus is shifting, and you are now losing sight of other things that could also become problematic and could also take you into the same situation. Movement over time, or more important than a single result. There's a lot of other things that could also influence DSO. Let me give you an example. This is now exaggerated DSO, an exaggerated example. Let's, for instance, say you supply a lot of small engineering and companies with product or something in the Rustenburg area. And tomorrow, God forbid, Anglo-America goes bankrupt in Rustenburg and the mines close. What do you think is going to happen to all of those small businesses that has been living off Anglo-America and is buying from you? If you don't understand where the product is going in certain of these instances, who they are selling to, who they are supplying to, who they are rendering a service to, and you do not see that there is a strain on that problem, that data of theirs, you're going to sit in the problem. A lot of times, especially where there is, I call it on-selling happening or on-services rendered, especially, I'll use this example in the construction industry. Let's say, for instance, you're a cement supplier, and you supply Martin Petzer, the constructor or the builder, and I am now building for someone, but they've got a performance management on me. I've got to lay a certain amount of bricks per day, per month to get my money. If I don't, there's penalties involved. Now I don't perform. They penalize me by not paying me or not paying me enough. I take the little bit of money that they did pay me and I pay my staff and I don't pay you. Do you understand the know your client? Why I'm carrying on about it? It's not just knowing them, it's knowing what they do with your product. Know who they're selling to. Know who they are rendering a service to. This can also have what you get seasoned buyers. The clothing and textile industry, very seasonal. Winter seasons. I mean, when the sale starts happening in these big companies, I'm talking about companies like Edgar's and Truworths and all those guys, they are selling off their summer clothes now. Why? Because they want to bring in their winter clothes, and it's different products they buy from different suppliers and things like that. And it's seasonal. In the agricultural industry, a lot of the agricultural suppliers have got two terms with a farmer. One, 365 days to accommodate the seed that they sell, and the other one is 30 days for the daily running of the farm. Understand your client, understand the stresses and strains and constraints that they will put on you, because if you don't, you are going to sit with a problem because you didn't understand the season or the movement of your client as well as you should have. And that's it. That's so quickly. Very slow. All right. I went very quick in that one. Now I must stop sharing. Or is it stop sharing? Can anybody hear me? Can anybody see me? Can anybody tell me if I've stopped sharing?
Yes, Martin, it has stopped sharing and we can still
All
hear
right.
you perfect.
Okay, guys. So that in a nutshell is what the DSO is about and the constraints that it can have for you. So how do I manage it better? Number one, always make sure that you understand, especially those big clients. You know, we always talk about the 80-20 scenario. 20% of your debtors, 80% of your money. That 20%, make sure, that's number one, you understand exactly what happens in their world with your invoice, how it goes through the whole process to get to Treasury to pay you. Know exactly what needs to be, and by when, because they've got a creditors cut off. You don't know when that is. Your invoice is not going to be on time. It's not going to be paid on time. What needs to be attached to that document? Where does it got to be delivered to? To whom? What is that person going to do with it? How long is that person sit with it? When is it going to go to the next person? How is it going to get to the next person? And then exactly how it's getting to Treasury. And then what does Treasury do with it? And how long does that take? The purchasing process. Is there purchase orders involved? What type of purchase order? Is it a specific purchase order? Is it a monthly purchase order? Is it a cap purchase order? Is it an annual purchase order? Is it an open-ended purchase order? Has it got a value connotated to it? All of these things. Those questions must be asked to your new debtor when you engage with them the first time, so that you know what you need to do when it comes to managing the invoicing process through your clients. That's number one. Number two, ensure that pricing is always correct. Always. Because if it's not, you're going to have a lot of queries. You're going to have problems. When deliveries happen, make sure that the delivery note comes back with a clear signature and a name on there from who accepted the goods and where the goods was delivered. Understand that. Because if you don't, there can be a dispute to say, we didn't receive this, we didn't sign for it, it's not us. Number three, make sure that your invoices leave and get to your clients as quick as possible. I very much doubt if there's still people that post invoices, but if you do, I would rather deliver them through a courier straight to the clients as quick as I possibly can, or even your staff do that. I'm with you now in a minute, Neil. I think you've got questions. As quick as you possibly can. Why? Because of the creditors cut off. If they don't receive that document in time, it cannot go through the process to get to Treasury to pay. Neil?
Hi, Martin. Yeah, just a question in the chat. You're correct. So a question from Tato. He's saying that we calculate DSO with turnover and overdues to get a percentage and not days. What is the best calculation, days or percent?
In the end of the day, both are going to tell you the same thing. But the DSO, if the minute it starts changing, it's a far more accurate way of understanding where the movement is. Is the movement negative? Is it going out? Or is the movement positive? Is it going down? A percentage doesn't necessarily, because there's value also in percentages. So when I say to you 10%, the movement is 10%. 10% of 10 Rand is smaller than 10% of 10 million. But when you have a value connotated to it, it gives you a far more better perspective of what exactly is. And if you do both, it's the same with overdues. To say my overdue percentage is only 8%, I still don't have a clear understanding of what it is. But if you say to me, my total debtors ledger is 500 million and my overdues is 8%, now I understand what 8% is. And that's where I say, measure the correct and show it correctly to understand what exactly the calculation means. What is the value connotated to? So if I say my DSO went 3 days, it doesn't mean much to me. But if I say 1 day DSO has got a value of 3 million and my DSO went out with 3 days, so now I've got 9 million rand less cash with me. It's somewhere out there. Now it's got a value connotated to it, and it means something more to someone that I'm telling them what is happening. And if I say I've improved my DSO by 3 days, I say we have now got a better cash flow situation of 9 million. Now there's value to it. Or if I've reduced my overdues or my outstandings by 20%, what does it mean? My overdues were this, 20% of that is this value, and now I've got a value connotated to it, and that's really. In the days that I had a credit team, we measured two things. We measured DSO and we measured overdue as a percentage value. However, unapplied cash plays a critical role when it comes to overdues because the cash is lying here and the overdue invoice is lying here. And those need to be applied as quick as possible. Another measure that I use very critically, credit notes and cash lying unapplied needs to be applied against the outstanding invoices as quick as possible. So some companies don't put the cash on the debtor's account. It lies in an unapplied account, and the debtor's account is in an overdue, and it gives you a negative DSO. Yet the cash is there. So when you apply the cash against the invoice, it brings the overdues down, it brings the outstandings down, it changes the DSO. So another thing that influences the DSO, apply the cash advice. Otherwise, you will create another query for yourself because the client will come back and say, I didn't pay this invoice, I paid that invoice. I didn't pay that invoice, I paid that invoice. So make sure you get it in writing from the client, unless it is a one invoice, one payment. Some companies, you have one invoice and one value, and the guy pays that value, and of course, you know, it's for that invoice, you clear that invoice. When they pay in round amounts, but a different problem. Because now what do? Do you pay the invoice partially, or do you leave the cash there until they pay the rest of the cash? That's the problems that you're going to start sitting with. All right. Any other questions around the DSO and the calculation? Just one more thing. Let me quickly share something with you. Someone asked.
While you are sharing, there are no other questions in the chat so far, Martin, but I will let you know.
I'm just going to try and see, why am I now in this?
End of slideshow. Click to exit, see what happens.
It's not doing anything. Oh, there we go. All right. So someone asked about the correct way to calculate the DSO, most accurate way, and this is the formula that you would use. So with other words, you'll have your current value in your aging there, you'll have your 30-day value in your aging there, you'll have your 60-day value there, you'll have your 90-day value there, 120, 150. I'm just putting them all in there if you go that far. And the sales value, the relevant period, current will be this month's sales. 30 days will be last month's sales. 60 days, 2 months back. 90 days, 3 months back. The actual sales value of that month will go in there, and you'll do a divide into the value of the current or the value of the 30 days. It will give you a number that will probably be very close to 30 days or 37 days or 32 days. Or if you receive payment before the time already, it might be lower than 30 days. And then that will give you, and then the end of the day, you will add all of that up, and that will say your total DSO for your debtors ledger is 37 days or 42 days or 28 days, because each one of them will be, because sales that is outstanding there is relevant and is related, especially people that have seasonal sales, and the sales values differ in different periods. You'll use this complete total debtors method. Unshare, is that not unshare button? There we go. All right.
There we go. Success.
Yes. Ja, ek het myself amper in 'n hoek geverf hierso vandag. I nearly painted myself into a corner here today. But thank you to Amy and her brilliance in supporting me in my technology hampering. But I'll get there. I've learned something today. Thank you guys for listening to me today. If there's any questions, if you have any queries or anything, please pop it in the what's name, or you have my direct mail address, or Amy's, or Neil's, any one of us. Give us a shot, give us a phone number, give us a call, write us a letter, send us a pigeon. I will send pigeons. I'm from the old group, and let us help you with whatever your constraints are and how you can improve DSO and improve your cash flow. Thank you very much.
Perfect. Thank you, Martin, for such an informative session on the DSO. Really appreciate it. Thanks, everybody.
Join us every Thursday from 10 to 11.